Hi, I'm Alex. Welcome to the channel and thanks for tuning in. So in today's video, we're talking about a new SPAC to the channel, and that is Apex Technology Acquisition Corp, or ticker APXT, and its merger with AvePoint. Now there are loads of really exciting things about this company. However, there are also one or two things which we as investors definitely need to be aware of and do have a meaningful impact on the investment thesis. So as always, we'll discuss those as well and the potential mitigants against those. So currently the merger is expected to complete in Q1 of this year. It looks like a solid team behind this. However, I do think the co-CEO and CFO has potentially their most unfortunate name at the moment, Jeff Epstein. Now it goes without saying, it's obviously not the same guy. There is no connection there at all. I just feel really sorry for him with that name. As is always the case on this channel, in our videos we look at things that nobody else has mentioned yet before, and that's exactly the same case with this video. As well as this, I've done some analysis which we'll touch upon, which should give us an indication of a fair valuation. So you definitely don't want to miss this one. If you're new to the channel and you like investing related content, then hit that subscribe button. Now I've also been told by a number of people that my videos don't seem to show up on their homepage. I think partly that's due to the fact there's a fairly inconsistent upload schedule to this channel. Whilst I guarantee there will be 2 to 3 really good videos uploaded to the channel each week, I can't guarantee, given my job, when they'll be. The algorithm ultimately doesn't like this, so it means not as many of you see my videos. If you want to make sure you don't miss those, hit that bell next to the subscribe button, and that will make sure it's definitely on your homepage. If you like the video, please smash the like button. It's so helpful in pushing the channel to a wider audience. And as always, I'm not a financial advisor. This video is purely for educational and entertainment purposes only, but let's get straight into it. So, what does AvePoint do? In the most simplistic terms, AvePoint helps companies migrate to the cloud, manage their cloud infrastructure, and ultimately help protect the data they have on the cloud. It has a SaaS solution and serves a wide variety of customers across a number of different industries. One thing to note at this point in time is they work exclusively with the Microsoft cloud. So, what are the real positives here? Well, firstly, it's a really high growth market. It's seen fantastic historical growth, and the forecast growth ultimately looks very positive as well. This is underpinned by a number of strong tailwinds. What's more, recent developments such as the health crisis have accelerated this trend. The need for companies to access data anytime, anywhere, and the need for companies to be able to work remotely effectively have all driven an increase in the demand and an increase in the acceleration of the digital transformation, the shift from companies from legacy solutions to SaaS and cloud solutions. During this same period of time, the regulatory scrutiny and focus has increased. This ultimately means that companies now face much larger penalties than they did before for mismanaging their data and not complying with the regulations. For AvePoint, this is great news. Not only do its customers want to transition onto the cloud, there's now greater pressure and greater regulatory focus pushing them onto the cloud as well. Ultimately, all of these factors in play have accelerated the need for companies to be on the cloud, have accelerated this trend of digital transformation, and ultimately this underpins the forecast growth assumptions. Currently, AvePoint has a small market share. However, this is great to see. There's the opportunity for AvePoint to grow very quickly, to capture massive amounts of market share, and ultimately deliver growth in excess of that of the market. As investors, this is great to see. Now, one important thing to note here is that whilst the recent health crisis may have accelerated this trend, I don't believe it's going anywhere. This is the new norm. Companies need to have a more flexible approach to their workforce. Firstly, because it's a good recruitment, a good retention tool for its employees. Employees like to have flexibility around where they can work and when they can work, and so that's important and won't change. Additionally, lots of companies have realised that there's no longer the need for large real estate. Large offices in expensive real estates in the middle of cities is no longer required in the same way. So it's a positive for companies in that they can generate massive cost savings there. What's more, once you transition to the cloud, the journey's not over. You need to remain focused on how it's managed and how it's protected. Two services which are core to AvePoint's proposition. Now the next great thing is that this is absolutely mission critical. There's no way about it. Companies need access to the data. There's no compromises, there's no substitutes. Companies need immediate and accurate access to their data. What's more, it's almost self-fulfilling. The more access to its data a company has, the more efficient it can be and the more profitable it can become. Because of this, the demand is absolutely non-discretionary. The regulatory focus and requirement for compliance makes it even more so. Now this non-discretionary demand is so important for two main reasons. Now firstly, it's the resilience. Now if you've seen any of my other videos, you'll know how personally important resilience is to me in the companies I invest into. Analysis has shown that during market downturns and during recessions, companies which demonstrate the greatest resilience are those which perform best, and in the long run will generate you superior returns. So in the case of AvePoint, because the demand is so non-discretionary, because this is so mission critical, companies will only stop using their services when they go bankrupt. Access to your data is one of the last things you'll let go in any situation. Now when you think about corporate bankruptcies, the majority of these occur in SMEs. Now if you look at AvePoint's customer base, the majority of those are larger blue chip companies. This is good to see and ultimately gives me confidence that AvePoint has a very resilient offering. Now, keeping in mind that mission critical nature of the demand, we come on to the next important point to discuss, which is the recurring revenues. AvePoint has great recurring revenues, and I always love to see that. Now, when you see a company with strong recurring revenues like this, underpinned by demand which is totally non-discretionary, is absolutely mission critical, we ultimately want to see good, consistent price growth year on year. In these situations, it's important that the company is able to increase its prices to its customers annually. And as we can see, AvePoint definitely does that. Its customers are very sticky, and ultimately its customers have very diversified end markets too. Now, AvePoint has a net retention rate of 106%. That ultimately shows that the increase in price offsets any loss of customers they have. And that's good, that's important to see. Every company will have some churn, whether that be the result of customers going bankrupt or companies merging and not needing two cloud infrastructure providers. Every company is going to lose customers. However, in situations like this, where the price increase offsets that, it's always positive to see. If this was less than 100%, that's when there'd be red flags and that's when I'd be a bit more concerned. Now, the next positive is the strong customer proposition they have. Customers can't do this themselves, they need somebody to help them. There's a very strong ROI, return on investment, underpinning this. And ultimately, AvePoint has very limited competition in some of its core verticals. Again, that's good. It further enables them to annually increase the prices. AvePoint also have a good management team. They've delivered on the strategy to date, delivered good growth within the business, helped drive the business to become EBITDA positive, and ultimately they've outlined a good growth plan. However, it's not overly ambitious. It's absolutely in line with what they've delivered previously, and this is always good to see. An unrealistic plan makes you lose confidence in management. So again, for me, this just gives me more confidence in the capability of management. Now, the final positive I want to touch on is the financial profile. Great to see the company is now EBITDA positive. There's no cash burn, and there's no expectation of a further need for funding. Ultimately, that's good. For us as investors, that means that down the line, there's not going to be new share issuances because they need to raise more cash, and that means we're not going to get diluted. Again, that's good to see. So now, what are the risks and what are the key mitigants to those risks? Well, firstly, the one we need to discuss is the concentration to Microsoft. Now, personally, when I make investments, I don't like seeing any concentration to any supplier. So immediately for me, this is a red flag and something to look into. Ultimately here, we're exposed to the risk of Microsoft going direct to the customers, cutting us out of the equation. We're also at the risk that Microsoft loses its focus on its cloud infrastructure. It makes mistakes, it loses its way, and ultimately through no bad management of the company itself, it finds its market shrinking and it in a very challenging position. However, personally I do think there are some mitigants to this. Firstly, it's clearly a core part of Microsoft's strategy, so I don't think that's going away anytime soon. What's more, there's much more of a symbiotic relationship here between Microsoft and AvePoint. Microsoft rely on AvePoint for its route to market. Ultimately, AvePoint are creating revenues for Microsoft, and that's important. So ultimately, these mitigants give me some slight comfort over the fact this isn't a traditional supplier relationship. It's much more of a two-way relationship and there's value on both sides. I see it almost more of a partnership with Microsoft. Now, next up, the thing we need to talk about is the small shareholding in AvePoint, which investors in the SPAC will have in the pro forma entity. The way it will work out is that investors in Apex Technology now will end up with around 17.6% shareholding in the merged entity. Now, some may see this as a risk, but personally I think it's fine. I've seen it as a criticism of many other SPACs this year, but ultimately what it comes down to is valuation. This doesn't unduly worry me, and what gives me more confidence in fact is actually the large stake which management will have in the pro forma entity. It shows how focused and concentrated they are on delivering this strategy. All their eggs are in that one basket of making sure that they grow the equity value in this business by growing the company. That's ultimately how they'll make their money, and for me, that's something I really like to see. It is the truest form of aligned incentives here. Now, the next risk we need to talk about is potentially the high valuation. Now, one could definitely argue that we are at the peak of the market in terms of valuation. We've just seen a very rapid acceleration of the already fast-growing trend of digital transformation. The sector is very in vogue, it's had a lot of investor attention. So it definitely is a fair question to ask, is this overvalued? Are we investing at the peak? To add more fuel to this fire, AvePoint had around a year ago a Series C funding. It received investment from 6th Street, and from then to where we are now, there's been a massive growth in that valuation. However, when you look at it, I certainly believe there are some mitigants here. If you look at its core peers and how they're trading currently, there's certainly an argument for some upside there. Let's take a look at this page from the investor presentation, for example, and let's look at its closest peers. Alavara here is a tax compliance business. Now, personally, and I think a lot of people in the market suspect that actually there's some question marks around how achievable and how deliverable forecast growth levels are. However, despite this, it's still trading at a premium to AvePoint. Five9 is actually very similar to AvePoint, and look again, it's trading at a big premium. RingCentral, a unified comms business, and HubSpot, a digital marketing SaaS business, are a little more different from AvePoint. So ultimately, I do believe the closest comparable is Five9. Now, doing some analysis on this, if we were to assume that AvePoint should be trading at the same sales multiple that Five9 is, this would imply a share price of around $27 for AvePoint. Now, I have actually done a detailed valuation analysis here. If that's something you're interested in seeing, then please let me know in the comment section. If there is enough interest in seeing that detailed analysis I've done on the valuation, then I'll definitely share that. However, for me, the quick takeaways from this is that there's definitely headroom here for further price growth for AvePoint, and that actually versus peers there is some upside in valuation. So yes, whilst we may be investing at the peak of the market, relative to its competitors, it is ultimately undervalued on this analysis. Now the final point we really need to be aware of here is that actually the growth may not be deliverable. The acceleration in the growth trend, catalysed by the health crisis, may not be sustained, and that we may see much lower levels of growth. Now personally, that's not something I can see happening, and I don't believe it's the way the market has reacted before. However, as investors, it's something we definitely need to keep in mind. Again, in my detailed valuation analysis, I have looked at the impact on lower growth rates and what that would mean for the valuation. So if people do want to see that, then I can explain how that works and what that means for us. So with all that being said, what am I doing? So personally, I have made an investment into this company. I like the long-term growth trends. I like the dynamics, the mission-critical nature of the product, the non-discretionary demand, the sticky customers, the high levels of recurring revenue, and the good retention rates. I am very cognizant of the high valuation. However, I do believe on the basis of the analysis which I've done, it is undervalued versus its peers. For me, this is a long-term play. I'm going to hold it for a number of years and see this growth plan play out. And by then, I expect the company to have a much larger customer base, to have grown significantly, and over that period of time delivered consistent price growth annually. So thank you so much for watching. If you enjoyed the video, please smash the like button. If you're new to the channel and you like investing related content, then hit that subscribe button. And as always, please let me know your thoughts and comments in the comment section below. I find it so interesting to hear everyone's thoughts, opinions, debates. There's always some fascinating discussions going on there, so please get involved. But thank you so much for watching, and I'll see you in another video.